Hi, my name is Chase Black. I work at the Evanston branch of Western Ag Credit. I'm a senior loan officer there and have been there coming up on 8 years now. I love serving the agricultural producers in the area. We cover a large area there out of the Evanston branch. I have customers in Summit, Morgan County down in Utah, over into Rich County, up into Uinta and parts of Lincoln County, and even over into Daggett County in Manila. So I am talking about financial statements today. An exciting topic, but I do really love going through financial statements with customers. It's such a good opportunity to see how a business is doing, to be able to make effective plans, and to really just get to where a business, an operation, or an individual wants to go with their agricultural operation. The core financial statements that I'll be talking about today are the balance sheet, the earnings statement, and the cash flow statement. Each one of these financial statements are a great tool. Each are a tool that can effectively help a business and a lender evaluate a business or an applicant. They all work together to help someone make a sound decision. The balance sheet is a great starting point as we are looking at the different financial statements. It is a cornerstone to these groups of statements, and it is effectively just a snapshot in time of somebody's or a business's financial position. You'll see at the top of a balance sheet there's a date, and so that's that snapshot on that date of this business or individual. Ideally, it's a year end or an end of an operating cycle, and we really like that date, whatever that date ends up being, to be in line with the earnings statements. So each one of the financial statements can kind of work together. You'll see as we talk through these different slides. The balance sheet data is a result of all of the past investments, operations that businesses went through, and the decisions that a manager has made. And as we collect these series of snapshots, hopefully just going from a year end to a year end balance sheet, we can kind of get a status report and see the changes that have made to an operation. Hopefully they're in an upwards direction and increasing their net worth. The way a balance sheet is organized, you'll notice we have assets that are on one side, typically on the left side of that financial statement. These are everything that's owned by the business or individual. Now, I will say I've seen some people hesitate to put maybe a truck on the asset side because they say, well, I don't own it, the bank does. And the thing you got to remember is maybe the bank has a lien on it, but what's shown on the title of that truck is the owner, that individual or that business. So we want to list everything that is owned by that business or individual on the left-hand side of that balance sheet. Those are the assets. On the right-hand side of the balance sheet, we'll list the liabilities and sometimes even the owner equity on the right side of that balance sheet. And this is because of the formula that we ultimately refer back to, that the net worth is assets minus liabilities. This is just the way we organize this information. Another way we organize on the balance sheet is putting the most liquid things at the top, and we move towards and down through until we hit the most permanent things at the bottom. The current assets are the things that will be used within the year. They're really fluid, or that's your liquidity, and these are things that can easily convert to cash. The intermediate assets are assets that have a 2 to 10 year life. They are really important to operations and the productivity and the annual income of a business. They're not as easily converted to cash, and you're definitely going to see a disruption to to operations as intermediate assets are taken out of that category. And the very most permanent assets, of course, are the long-term assets. This is usually real estate. We'll get to that in a minute. Again, the current assets are your most liquid type assets. And you'll see with our list of current assets here that some current assets are even more liquid than others. Obviously, our very most liquid assets or current assets are going to be our cash, checking, savings accounts. And as we move through there, maybe a little less liquid current assets are our feed inventories that will eventually make it around to cash or be put into operations. But maybe our cow herd has to eat that feed first and grow a calf inside of her and then have the calf and then finally sell the calf the next fall. So not all current assets are created equal. Our intermediate term assets include production livestock, any machinery or equipment, vehicles, retirement accounts. You can see these things aren't as easily converted to cash. And long-term assets are going to be your real estate type assets. It could be a note receivable. A note receivable is where an operator or a business might have a loan out to somebody else and they are repaying them. So that would be considered a long-term asset as well. It could also be ownership in some other entities. For example, on an individual's balance sheet, they might have the ranching entity or operations entity, and they might have a landholding entity as well. And sometimes we'll bring the net worth into the long-term asset section, or we might list a total of that entity's assets and their liabilities. As we look at the right side of the balance sheet at liabilities, there are three categories here. Again, the same categories that look very similar, of course, to the asset side. Current liabilities can include the balance on operating loans, credit cards. We hope they're paid off monthly, and hopefully you don't carry a balance of credit cards, or at least a major balance. Could be accounts payable or even the current portion, your interest and principal payments that are being made on intermediate or long-term notes, because those will be due within that operating cycle or within that year. Intermediate liability can include cattle or livestock loans. It could be a truck or a tractor or other equipment loans. Some leases can even be considered intermediate term liabilities. And of course, credit cards that don't pay off monthly could be considered an intermediate liability. Most of your long-term liabilities are going to be real estate loans. If a loan is secured by real estate, that's typically the offsetting liability on the other side is that real estate loan. So ultimately, the balance sheet is going to tell us that individual or that business's net worth. The net worth, again, is the difference between total assets and total liabilities. And the net worth, whatever that difference is between total assets and total liabilities, that is how much the owner effectively has invested in that entity, or how much that owner actually owns of his balance sheet. It can also be an indicator of how much earnings has been retained back into that business or that operation. The balance sheet is a great tool because it tells us several things. It's going to list out and give us a list of available assets that we can use to collateralize a loan. It's going to indicate the performance of a business as we go from balance sheet to balance sheet, and we get a series of balance sheets, and it's going to demonstrate that business or that individual's liquidity and solvency, as mentioned in the 5 C's of credit. You might recognize this. This is the capital C that we're really nailing down with the balance sheets. An earnings statement is effectively how much you or that business made in an operating cycle or a year. Typically, this is a full year from January 1st to December 31st. Accurate historical earning statements can help the individual or the business or even the lender make good business plans and the most accurate projections for future operating cycles. That's why they're so essential. The different components of an earnings statement, we start at the top with the income, and we like to focus on the farm income. This is the value of the products or the services that were produced in a normal operating cycle. So we're going to take, of course, the cash sales, and then it is really important and essential that we do an accrual adjustment. We take into consideration the inventories from the beginning of the year or the operating cycle to the end of the year. And this is critical. This is some information we can pull from the balance sheet. Again, these statements and this financial information works together. The reason it is critical, for example, in a cow-calf operation, if we have a 200 head cow-calf operation and a rancher, of course, sells his usual production for the year, his calf crop, but let's say he sells an extra amount of coals. Maybe he has an extra 50 to 100 head. Maybe he cuts his herd in half and his herd size goes down. Well, the income, the cash income that year looks great. There's an extra $50,000 of income that came in that year. But if we don't make the accrual adjustment for that, taking into consideration the change in his herd size, then we miss a big piece of information there. The next year, he's going to have a smaller herd size to produce the next year's calf crop, and his net worth is essentially going to go down, or that shouldn't have been a change in his net worth when he sold his production herd. After we figure out our income side, of course, we can move to our expenses. These are the costs that are associated with producing the income side that was shown above. To determine the total expenses, we look at the cash that was spent to produce the product or service that was shown on the income side. And we also make an accrual adjustment for the expenses as well. For example, if an operator produced a lot of fuel or some other prepaid expense, it's going to make the expenses look bigger in that particular year, but he has an inventory or a value on hand that he won't have to spend as much the next year on fuel. So we want to adjust for that change in inventory. Some other components of the earnings statement that are important. Depreciation is not a cash expense. That's not something that we're going to realize or see every year unless we calculate that in. It can eventually come around and sneak up on a producer if we're not keeping that in mind. Another aspect is the gain or a loss on capital assets. If there's a capital asset sale, such as a tractor sale, maybe we have a tractor on the balance sheet at $50,000 and the producer was a wheeler and dealer and was able to get $65,000 out of that tractor when he went to sell it. We'll add in another $15,000 into the gain or loss of that capital asset. The full $65,000 sale of that tractor wasn't an earnings or an income. The extra $15,000 might have been. The net farm earnings is an important or a key focus for us as we look at the total farm revenue less the total farm expenses. And that's a figure, of course, that Western Ag Credit likes to pay attention to. This non-farm income has become more and more important as it can contribute or help supplement to make ends meet and to be able to meet the debt obligations that might be facing a farm. Ultimately, what we want the balance sheet and the earnings statements to be able to tell us is the earned net worth. This is the number one bottom line figure that shows if a business is generating a profit and if it is a viable business or an operation. The earned net worth can be calculated with accurate information from the balance sheet and the income statement. Now we want the balance sheet and the earnings statements to tell the same story, and we want the net worth changes to align as we look at the net worth that results from each statement. As we look at the balance sheet from the beginning period to the ending period, we can calculate this earned net worth, and we need to take in consideration any gifts that were paid in or out of the business, inheritances, or capital that was received or paid out. We also need to consider any purchases or improvements to real estate, equipment, breeding livestock, capital items. Sometimes I'll ask a producer what purchases or improvements he made to his real estate, and sometimes they'll say, well, we fenced this piece over here. That fencing, if it's an expense item, we shouldn't figure that in. What we're trying to figure in here are what things are you going to have your accountant depreciate, not the expense items, because the expense items are going to come in with the profits or losses that come from the income statement into the balance sheet. Other things we need to consider, of course, are any sales of capital assets or other items that were included or excluded as we went over the balance sheets that might have been an error in there. Ultimately, to calculate the earned net worth for a time period, we take the beginning balance sheet net worth and subtract the beginning balance sheet net worth. And of course, we take into consideration the different adjustments that I just mentioned. Why do we want to do this? We want to see what the actual profitability of the operation is. And we want to make sure that we are adjusting for any appreciations or inheritances that come in. And we want to nail down what the actual earned net worth change is. The final financial statement that we want to review today is the cash flow statement. The cash flow statement covers normally just one operating cycle. And how we structure our cash flow statement is a month-by-month analysis, looking at when incomes come in and when expenses or debt payments go out. This can help us look at a few different things. We want to ultimately look at how the business is going to cash flow. Is there going to be a need for an operating line? And if there is, how high does that line of credit need to be, or what is the need going to be for the cash flow of that business or that operation? The cash flow statement is going to help a producer develop a good marketing plan and to be able to plan for the different timings of incomes coming in and expenses going out. The way we develop a cash flow statement is by using the previous years or multiple years cash flow records as we look at the income and expenses, when things came in, when things went out. And we can make adjustments to what we might be planning for in the upcoming operation. And it is really smart as well if you have different enterprises within your operation to separate those out, so you can look at the cash flow of each different enterprise. It's really important that when you're developing a cash flow statement to be realistic. We don't want to project 600 weight calves coming in if we only had 525 pound steers come in at the end of the year. We also need to use reasonable commodity prices. We don't want to throw in just the figure that makes the cash flow work. We want to be realistic with the figure that we project our yields and our commodity prices coming in at. We need to consider each expense and all the expenses that might come in, and it's smart to build a little buffer. It's better to plan for higher expenses than to come in a lot higher than expected and have a surprise there in the middle of the year. If we are taking into consideration a long-term loan or a long-term purchase, we need to use prices that are over a really long period of time. Again, these statements all work together so that we can see where a business has been, where it currently is, and to be able to make good projections about where it's going. The statements will help us determine the strengths of the business so we can keep those going, or the weaknesses so we can improve on those weaknesses. And with this information, both the applicant, the producer, and the lender can make informed decisions and can determine if that business is going to be able to continue going forward and to be profitable. Thank you for your time listening to this presentation about financial statements.